their tax returns. Let's talk about the deadlines now, because there was a big change last year, and so folks are still adjusting to the big change, which is the swap between the pass-through entities and the corporations. We'll talk about that briefly. So specifically for folks that are watching this, are small business owners, not necessarily tax practitioners. January 16th will be the last day to make your estimated taxes for last year. Okay, even though the taxes are due for most individuals on April 15th, April 17th this year, because that lands on a weekend. The April 17th, you can still pay your whole tax bill on April 17th, but there's a small penalty that has to do with not making those estimated payments. So I would say that at least by January 16th, so that's only a few weeks from now, make your last payment for 2017, so you get the least amount of estimated fees for not making estimated payments. By January 31st, you must file your W-2s, your quarter 4 941s. This is for employers. You must file your 940s, also for employers, and your 1099 forms are due January 31st, whether they're paper filed or e-filed. There's no more extension to February or March for electronic filers of 1099 miscellaneous forms for contractors. There's some exceptions for other 1099 forms that has to do with not subcontractors but other things, but for the most part, January 31st is going to be a huge deadline. Now, for folks in Texas and Florida and their clients that have been procrastinating for the 2016 tax returns, there's also another extension for 2016 tax returns to file your 2016 returns by January 31st. And I got about 16, 17 clients I haven't filed yet, so my January is going to be a lot of work. So that's only for the folks that have to do with Irma and what was the other hurricane, Harvey. And I assume Puerto Rico as well, but I don't know what the Puerto Rico deadlines are. Now, for S-Corps and partnerships is March 15th. This was a big change from last year, where partnerships used to be, the deadline for partnerships used to be April 15th. They were moved now to March 16th, and they swapped with corporations. Corporations are now due at the same time as individual tax returns, which, by the way, I like to give credit to the IRS. This makes a lot of sense. You know, you do all the non-tax paying entities and pass-throughs by March 15 to allow the tax preparers to have all those K1s and stuff to then prepare their personal returns. It's actually really, really important swap that they did. But some folks are still confused about the March 16th and April 16th deadline for partnerships and corporations. They just swapped spaces pretty much. And for folks that are doing extensions, the extension for partnerships and S-Corps is going to be on September 17. Again, September 16th lands on a weekend, or landed on a weekend, so it's September 17. And for corporations and personal extensions, it makes sense, 6 months later, it's going to be October 15th. Go ahead and watch the YouTube video I have on the link below that talks about all the penalties and the process of paying your tax returns late. Just because most folks, including some of my clients, I explain it every single year that you will get a penalty for paying stuff past April 15th, even if you're on extension. So in that video, I kind of break down how all the IRS penalties work based on filing late, paying late, not making prepayments, estimated payments, and all that stuff. So refer to that YouTube video for that. Now on to the 2018 tax reform, which is actually not tax reform at all, in my opinion. I mean, I would say for corporations going from 35% to 21%, maybe you want to call that reform, but then nothing on the tax law was reform. I mean, it was 1,000 pages of addendums to the current law. True tax reform would have been scrap it and do it again. So I don't know who's bragging about reform. Now, they call this the Tax Cut and Jobs Act. Okay, this is a marketing word, obviously, right? They're making it sound like it's all about tax cuts and jobs. And I know Jody will have her opinion about it. I'll give you my opinion on this as well. Please don't call this the Trump tax plan. Please don't call this the Republican tax plan. Please don't call this the GOP tax plan, or don't call it 2018 tax reform. It doesn't deserve any of those names. You call it the Tax Cuts and Jobs Act because that's really what its real name is. Anyway, let's talk about some of the major shifts. The biggest change, I would say the biggest transformative change, because it does existentially change how taxes are calculated, has been the brackets. The brackets, instead of being 10, 15, 25, 28, 33, 35, and 39, have been changed to 10, 12, 22, 24, 32, 35, and 37. What the politicians will brag about is the almost 3% difference on the top end, because that's really the easiest way to explain tax reform is to explain the top tax bracket and how it goes down, and is the one that has the pretty much about the biggest change. So the top tax bracket went down 2.6%, and the second to the bottom tax bracket went down 3%. Now, some of the also major changes you can see is how the dollar amounts have changed as well. So, for example, last year you made, if you were single and you made $418,000, you were at the top tax bracket. Now you have to make $500,000 or more. So it's not just a lowering of tax bracket by 2 to 3%. It's also changing the income levels that hit that tax bracket. So it may not just be that straight 2 to 3% reduction for you, depending on what bracket you are. You could also be completely shifted to a lower tax bracket. Now, on the middle tax brackets, there isn't that big of a dramatic shift. You know, like there's even I would say, I think for the most folks that make between $100,000 to $150,000, I think this tax law is not going to do mostly nothing, pretty much. You know, which is the middle class, which is kind of weird. But the other existential change, and again, Jody will go into more detail, has been the removal of personal exemptions. So before, for yourself, your spouse, and every dependent, which was a kid, I mean, there's so many types of dependents, but it could be a kid, it could be a parent, it could be some other sort of dependent. For every single dependent that was on your tax return, you got an automatic reduction straight from the top of your income of $4,000. That has been completely eliminated. But the standard deductions, or folks that don't itemize, folks that don't really get into detail about what's deductible and what's not, they just take the maximum, you know, freely allowed deduction by the government. That deduction has been doubled. Now, that doesn't necessarily mean it's tit for tat. Like if you used to have, you know, 9 kids, and I don't know how many of you are out there, but if you have 9 kids, you know, you had to, you know, the first $36,000 that you made plus you and your spouse was completely tax-free because of the exemptions. Now that's not true anymore. Now they replaced it with a tax credit, and I'll allow Jody to talk about that, but they doubled the tax credit. But that's the biggest existential change. What this also means, or it could mean, that a lot of tax preparers that were doing a lot of itemized deductions, and they were making a living with those itemized deductions, but they don't quite get to the doubling of the standard deduction, they may not be needed anymore. So I think that some of the higher end tax professionals will definitely have a lot of work, but some of the run-of-the-mill guys that used to, or guys or gals that used to do a lot in itemized deductions, possibly won't. Especially those I don't want to knock H&R Block or anything, because you know they're an amazing company from a growth perspective, but that's about it. But some used to have, you know, like mileage for unreimbursed expenses, that's not gonna be here anymore. So that has, I think the itemized deduction and standard has been the biggest change. On married filing jointly, there's an important thing to note, and Jody, I'll ask you in your part if you actually noticed this. Normally, when you go from single to married filing jointly, so when you actually do that doubling, the brackets actually double. And if you notice, for example, on the final plan on the right side, we have $38,000 is the limit for that second tax bracket. If we go to the married filing jointly, is $77,000. That looks like a doubling. But if you look at the most bottom tax bracket, which is $500,000 or more, sorry, at the highest and the bottom of the list, notice that it doesn't double. So there is kind of a weird penalty on the folks that make $400,000 and more that are married filing jointly. There's a weird, strange sort of penalty on married filing jointly. There could potentially now be a situation where 2 folks that could be single or married, let's say they're thinking about getting married this year, and they're asking you for tax advice, and they're saying, should we get married to get a tax break? Let's just say that's the case. And each of them makes $300,000 or $400,000. It's possible that it's much better for them to file single for the first time in 35 years married filing single could actually be better than married filing jointly, which historically was never the case. Jody, did you pick up on that sort of weird penalty for married filing jointly?
I did, but I think it's interesting because so many other things are changing that I don't think you can just look at it by itself, right? So I
Right.
think
Yeah,
that's
I'm
the
not
big thing,
criticizing.
right?
Yeah, I'm not criticizing it in an isolated way. I'm not saying that there's something wrong with it because of it. I'm just saying that it's quite interesting to see that all the tax brackets double from single to married filing jointly, with the exception of the 35 and above, which is doesn't double. So I think I mean, again, I've had some, I've married some folks, in November or December, where people are telling me, hey, should we get married now or in January? And we've done the tax example, and it actually made sense tax wise for them to get married, at the before the end of the year and the next year. So I've actually married some folks, and I've actually had some folks have kids in a year because of the tax. I mean, I don't want to get into that, but just on the advice portion, I wasn't involved in the other piece. But yeah, so that could also be the case this year because there has been a significant change on that tax credit. So I'm going to go through the summary, and this is just quick highlights before after this, I'm going to give it to Jody. So some of the important highlights about the change, which I think these are the talking points that if you're in a party and you're an accountant, somebody says, tell me about tax reform, and you want to do it in 5 minutes, just go through this 10 bullet points, and you've covered everything. So one, tax brackets have been changed between 2 and 3% for most folks. The personal exemptions has not just been reduced, has been sort of replaced with double standard deduction plus child tax credit. Okay, if you used to have a lot of dependents that were adults, non-child, that will not be a benefit for you. But if most of your dependents were child, then it will be a benefit for you because the child tax credit doubled. There's no changes to earned income credit, which I just do my quick politic rant. If I was a Republican and I wanted to stick it to Democrats, I would have gotten rid of earned income credit. But I don't understand why they kept earned income credit. This basically means that the same 45 to 47% of Americans that pay no taxes will be in the exact same position. So we're not getting any more Americans to pay taxes with this tax plan. I think we're just moving around for the ones that already pay tax. Okay. Now there's a limit to the state and local taxes that it has been limited to $10,000. That means that the folks that pay state tax, which in Florida we're fortunate not to, so it's not my problem. But the folks that pay that, especially on high taxable states like New York or California or Illinois, and I don't know which other ones to mention, but those typically would get a deduction for paying that state tax. That's now going to be limited to $10,000. So the first version of this bill was going to repeal it completely, and I guess through the reconciliation they kept it at $10,000. So for the folks that historically itemized, that are on high income tax states, this tax law could hit them a little bit harder. Now, was this a politic move to stick it to the blue states? Maybe, right? I mean, there are some red states that have high income tax. I think Iowa is one of them, and Pennsylvania, which voted red, also has pretty high. So I don't think it's just a politic thing. It's just what they decided to do. Now, for some reason, they rolled back medical expense deduction from the 10% floor that happened during the Obamacare sort of tax change, or during the Obama era, that increased from 7.5 to 10. They rolled it back to 7.5. This is the minimum amount that you have to spend in medical expenses before it becomes deductible. Mortgage interest, which is not going to affect a lot of folks, has been reduced from $1 million mortgages to maximum $750,000 mortgages. I think there's going to be a very small group of people that will be affected by this. Maybe in some of the blue states where real estate is over $750,000, you could see it. So maybe that was part of the logic, not sure. Now, home equity line, which used to be tax deductible up to $100,000 in debt, no longer deductible. Now, I believe that starts next year. So any mortgages acquired next year, not the old stuff, will be grandfathered. Charitable deduction used to be limited to 50% of your AGI. That has been raised to 60% of AGI. Again, I'm not sure how many more folks that already give half of their salary to charity want to give the extra 10%, and it may affect them, but there may be some that will. Now, there's been a removal of the miscellaneous deductions on the itemized deductions. There's been a removal of the general personal casualty theft losses, which is actually very small subsection of the population that takes it. There will still be federal disaster areas as an exception. Alimony deduction, which is huge, that has been removed, and that's also, I think, divorce decrees that happened after December 31st of this year. So any divorce settlements that happen this year, alimony will still be deductible. So only new divorces. And just so you know, the person that pays alimony used to deduct the alimony, and the person that receives the alimony pays taxes on the alimony. That has been fundamentally changed. Don't know where the logic on that is, but that's what it is. Moving expenses, if you move 50 miles away for a new job, you used to be able to deduct that. That has been removed with the exception of military, of course. State tax has been doubled. So if you die and leave your state to your family, now you have double that. So it went from 5 point something million to 11 point something million, small subsection of the population. However, for some tax practitioners like us that deal with small business owners that have been growing for 5-10 years, some of them are building states of 5 million, 6 million, 7 million, and this actually becomes a big deal to some of the folks that I'm dealing with and Jody is dealing with. AMT on the individual side, this alternative minimum tax has not been repealed on the individual side, but the limits have been increased. I don't want to get into that. AMT just kind of makes my head hurt. But on the corporate side has been repealed. And this is the biggest one, biggest one. There has been a repeal of the health insurance mandate, but it's as of next year. So this year you still have to have your minimum health insurance, otherwise you will get that big penalty. So I assume I'm gonna get a lot of my customers saying, I don't have insurance anymore because Trump, fixed it. Trump didn't fix it for 2018, and Trump wasn't involved. He just signed it at the end. This was all Congress. But the repeal happened it happens as of January 1st, 2019. I believe that's going to be the biggest misconception that a lot of folks are going to have, thinking that this year they don't have to have health insurance. They do. On the business side, quickly, because Jody will cover most of this stuff, corporate tax has been changed to 21%. It's a flat tax. That means that small subsection of corporations that have between $0 and $50,000 in income tax are actually getting an increase from 15% to 21%. You still have the double taxation dilemma that all C Corp owners have, right? That you pay taxes on the corp, pay taxes on the dividend. AMT has been eliminated for corporations. That is big to make tax preparation easier, and also big for some folks that have accumulated losses. I don't know if the losses are from the past, if the AMT would kick in or not. I'm not sure how the law, I don't think it's spelled out yet. I'll ask Jody to comment on that. If she knows, if you got accumulated losses from before, will the AMT kick in to disallow some of those losses? And for S Corps, partnerships, and self-employed individuals, including Schedule C filers, there will be a 20% deduction on qualified business income, but there's going to be an additional limitation for service businesses, which includes accountants. But until the IRS codifies it, I'm not qualified to tell you which businesses are or are not in this specific limitation of that 20%. But that right there is the mother of all deductions for small business tax planning. That new 20% deduction of the pass-through entities, plus the change in corporate. I suspect that this year there'll be a lot of folks with two corporations, and they'll be separating their businesses in two groups and be able to do some tax planning on their service stuff, non-service stuff with corps and S corps. So that should be interesting. Anyway, I'm going to skip that slide. I'm going to pass that on to Jody, and I'm going to shut up and let her speak for the next 30 minutes. Jody, thank you for coming.